The most famous company that had stayed off the stock market for decades finally landed on it. SpaceX went public, ticker SPCX, in the largest IPO in history. $75 billion raised, a valuation around $1.75 trillion, and a stock that opened at $150 and closed its first day at $161. And across the country, people opened their brokerage apps, typed in that ticker, and felt like they were finally getting a piece of SpaceX. Here's the uncomfortable part. The people who bought SPCX once it started trading and the people who actually got the IPO are not the same people, and they didn't get the same deal. Because an IPO isn't the public getting in early. More often, it's the early money getting out. So let's back up. IPO stands for Initial Public Offering. It's the moment a private company, owned by its founders, its staff, and a handful of early investors, sells a slice of itself to the public for the first time and starts trading on an exchange like the Nasdaq. For more than 20 years, you simply couldn't buy SpaceX. It was private. A piece of it was reserved for Elon Musk, the people who worked there, and the big investors who got in early. Once it listed, anyone with a brokerage account could own it. That transition, private to public, is the whole event. So why do it? Partly to raise money. The company gets a pile of fresh cash to spend on growth, and Musk has said he wanted it for a significant growth phase. But just as important, and this is the part to hold on to, the people who already owned shares finally get a way to turn paper wealth into real spendable money. Going public is the cash-out moment for everyone who was in before you. Here's how the machine actually works. A company doesn't just list itself, it hires investment banks. For SpaceX, Goldman Sachs and Morgan Stanley ran the deal to underwrite the offering, help set the price, line up the buyers, and make sure the shares get sold. That price is called the offer price, and SpaceX set it at $135 a share. This is the number everything hinges on, because the offer price is not the price you and I can buy at. The offer price goes to a select group, big institutions, funds, and a thin slice of retail investors who request shares ahead of time and get an allocation. The catch? SpaceX's deal was wildly oversubscribed. Far more money wanted in at $135 than there were shares to hand out. So most regular investors who asked got a partial fill or nothing at all. Then trading opens, and this is the revealing part. SpaceX was priced at $135. It opened at $150. It closed its first day at $161. That jump from the offer price to where the stock actually trades has a name: the pop. A first-day pop gets reported as a triumph. Shares soared on debut, but look at who captured it. The investors handed stock at $135 were instantly up about 19% the moment it opened. The regular investor who waited for the stock to start trading and bought at $150 or $161. They paid the pop. They bought from the allocated investors who walked away with a same-day gain. And there's a quieter point underneath. If the bankers priced the stock at $135, but the market was happy to pay $161, you can argue the company sold itself too cheap and left money on the table that went to the allocated buyers instead. A big pop is fantastic for whoever got in at the offer. It is not unambiguously good for the company. And it is definitely not free money for whoever buys once the bell rings. And here's what makes a debut like this especially wild. SpaceX floated only a thin sliver of itself. The freely trading shares were a small fraction of the whole company, and Musk kept over 80% of the voting control. When a tiny float meets enormous demand, the price can swing hard in both directions. That's why a brand new stock is often far more volatile than a seasoned one. There's simply less of it to go around. So put it back together. An IPO gets dressed up as your chance to finally get in on a company you believe in. And sometimes a genuinely great company does go on to reward the people who bought on day one. But mechanically, the event itself is the opposite of getting in early. The early entry already happened, years ago, in private rooms, at prices no headline ever printed. The IPO is the door those early owners walk out through. The public is who they sell to on the way. So the next time a company you love hits the market, ask the question, all the excitement skips right past. The IPO isn't your way in, it's their way out. And the thing worth knowing was never whether the stock pops, it's who's selling it to you and why they chose this moment to do it. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.